As of early April 2025, it takes over 100 ounces of silver to buy a single ounce of gold. That's a 5-year high in the gold silver ratio and has a lot of people in the metals world paying close attention. Now, historically, when this number spikes, it has not stayed there long, and silver tends to come roaring back. So let's get into the facts. Now, before we dive deeper, quick reminder, if you've been wondering how to hold actual gold and silver in your retirement savings without stashing it in your sock drawer, well, Goldco is offering something pretty special right now. You could qualify for up to an instant 10% match in bonus silver and a free Ronald Reagan half-ounce silver coin. Not only that, you get a free gold and silver kit in digital, physical, audio, and video formats. Just click the link in the description to see if you qualify, but it is first come, first served, so don't wait. Now back to the ratio. The gold-silver ratio is the oldest exchange rate in recorded history. It tells us how many ounces of silver you need to equal the value of 1 ounce of gold. On April 4th, 2025, that ratio jumped past 100 again, just like it did in 2020, one of the highest readings in modern times. To understand how weird this is, we've got to go way back. The Roman Empire officially set the ratio at 12 to 1. In medieval Europe, it dipped to 9.4 to 1 and climbed back to 12. The US fixed it at 15 to 1 in the Coinage Act of 1792. Now, for centuries, the ratio barely budged. Then came the 20th century, modern markets, and governments deciding they were done trying to control gold and silver. The result? Volatility. In 1939, just before World War II, the ratio hit 98 to 1 after President Roosevelt had set the price of gold at $35 per ounce. Then, in 1991, during a deep recession and low silver prices, the ratio peaked at 97.5. Fast forward to 2020, in the chaos of the COVID pandemic, it briefly shot above 125 to 1, its highest point in history. But here's the key. After each spike, silver didn't just stay in the basement. It rebounded, sometimes dramatically. Recently, we're seeing something similar. Gold prices have remained relatively stable, recently sitting around $3,019 per ounce, down just 2% in a volatile market. Silver, on the other hand, took a nosedive, falling over 13% in 1 week to trade around $29.62. That gap? That's what blew the gold-silver ratio past 100. So why is silver lagging behind this time? Part of the answer lies in its dual identity. Silver is not just a precious metal, it's also an industrial one. Roughly half of global demand for silver comes from manufacturing, tech, and energy industries, including critical uses in electrification. So when fears of recession pop up, like they are now, silver demand can potentially drop faster than gold. Another factor behind this imbalance is market behavior. When tariff threats started making headlines, bullion banks and big players began moving large amounts of gold and silver into New York vaults to brace for impact. These metals were ultimately exempt from tariffs, but the premium on futures collapsed, and now that arbitrage trade is unwinding, leaving a glut of silver on the COMEX exchange. Ole Hansen, head of commodity strategy at Saxo Bank, reported that silver flows into COMEX vaults are up 51% year to date, and that kind of inflow can flood the market, especially when demand is already shaky and pushes prices even lower. Historically, whenever the gold-silver ratio crosses the 100 mark, it hasn't stayed there long. Back in 2020, we saw the ratio spike and then contract quickly as silver outpaced gold during the rebound. According to Naeem Aslam, CIO at Zay Capital Markets, a ratio this high has often signaled a reversion, a fancy way of saying the rubber band is stretched and silver may be ready to snap back. And while no one's claiming to have a crystal ball here, the historical patterns are just hard to ignore. Over the 20th century, the average gold-silver ratio was about 47 to 1. Since the 1970s, it's hovered closer to 65 to 1, give or take. So seeing it above 100, that's like finding a $5 steak dinner. It might happen, but it usually doesn't last long. So if you're someone who's looking to help diversify their savings using precious metals as a hedge, Goldco has made it easier than ever to do that in a tax-advantaged way. Request your gold and silver kit and you may qualify for up to a 10% instant match in bonus silver and a free Ronald Reagan half-ounce coin. You get the kit in physical, digital, audio, and video formats, so no excuses unless you don't like free things. So click the link in the description to see if you qualify. So where does this all leave us? Gold is holding strong, silver is potentially on sale, and the ratio is flashing the same signal it's flashed before major silver rallies in the past. While short-term noise may be rattling silver, long-term history suggests it doesn't stay down for long. And if history repeats, as it tends to do, this ratio might be the clearest signal we've got that silver's turn could be next.